Good morning, everyone. Our subject is financial services, and we are going to learn about factoring.
Introduction to factoring. Factoring is like selling up your unpaid invoices, money your customer owe you, to a company called a factor. Instead of waiting weeks or months for your customers to pay, the factor gives you the most of money upfront, usually around 70 to 90% of the invoice value. Once the customer pays the invoice, the factor takes their share, a small fee for the service, and gives you the remaining balance. It helps businesses get cash quickly to manage daily expenses or grow without waiting for the payments, which means factoring is when a business sells its unpaid bills, money customer owe them, to a company called a factor. Instead of waiting a long time for customer to pay, the factor gives most of the money right away, usually 70 to 90% of the bill amount. Later, when the customer pays the bill, the factor keeps a small fee for their service and give the rest of the money to the businesses. It's a simple way for businesses to get quick cash to cover expenses or grow. Next, definition and mechanism of factoring. Definition: factoring involves selling accounts receivable to the third party for immediate cash, which means factoring means selling your unpaid bills, account receivable to a company to get cash immediately. Next, mechanism, in which first point is contract, which means the business signs an agreement with the factoring company. Second, submission of invoices. The businesses gives its unpaid invoices to the factoring company. Third, advance payment, which means the factoring company pays most of the invoice amount upfront, usually 80 to 90%. Fourth, collection, which means the factoring company collects the full payment from the customer when it's due. Fifth, final statement, which means once the customer pays, the factoring company deducts their fees and gives the remaining money to the business. This process helps businesses get quick cash and avoid waiting for customers to pay. Our next point is growth of factoring, in which first point is increasing demand for working capital, which means business needs money to pay for daily expenses like salaries, rent, or material. Factoring helps them get quick cash when needed. Second point is global trade expansion, which means as businesses are trading more across countries, they use factoring to handle payments and cash flow smoothly even in international deals. Third point is SMES, needs for quick liquidity, which means first SME full form is small and medium businesses obtain face cash shortage. Factoring gives quick access to fund without waiting for customers to pay. Fourth point is reduce reliance on traditional bank loans, which means businesses now prefer factoring because it's faster and simple pairing to the traditional bank loans, which have strict rules and take more time. Next, types of factoring. First, recourse factoring, which means if the customer doesn't pay the invoice, the businesses must repay the factoring company. Second, non-recourse factoring, which means if the customer doesn't pay, the factoring company takes the loss, not the businesses. Third, globalization, which means as businesses trade internationally, factoring helps them manage payments and cash flow across different countries. Fourth, technological progress, which means new technology has made factoring quicker and easier with online tools to manage invoices and the payments. Fifth, awareness and acceptance. More businesses now know about the factoring and trust it as a reliable way to get quick cash. Next point is regulatory aspects of factoring. First, licensing and registration, state regulations, which means factoring companies must follow state laws and get the necessary license or registrations to operate the legality. Second, disclosure requirements. Factoring companies need to be transparent about fees, terms, and the conditions. So, businesses know exactly what they are signing up for. Third, rules against money laundering compliance, which means factoring companies must comply with laws to prevent illegal money transactions and report suspicious activities. Fourth, law pertaining to privacy and data protection and maintaining confidentiality, which means law ensures that factoring companies protect sensitive customer and businesses information and keep it confidential. Next, tax laws, which means factoring transactions must follow the country's tax rules, including how taxes are applied to fees and the income. Sixth point is regulation regarding customer credit, which means if factoring involves individual customers, companies must comply with laws protecting consumer right. Seventh point is international law, means for cross-border factoring, companies need to follow international trade and financial regulations to ensure smooth operations. Our next point is forfeiting. Firstly, we will understand the meaning of forfeiting. It is a financial service where an exporter sells their long-term receivables, means money owned by the foreign buyers, to the forfeiter, a financial institution, in exchange for immediate cash. The forfeiter takes on all the risks, such as the buyer not paying or political issues, and the exporter gets their money right away. It's mainly used in international trade for large transactions with the longer payment terms. Next, we are going to learn points included in forfeiting. First, types of receivable, which means forfeiting deals with export related receivables like bills of exchange or primary promissory note where buyers owe money for goods sold internationally. Second, recourse. In forfeiting, there's no recourse to the seller. This means if the buyer doesn't pay the forfeiter, the financial institution takes the loss, not the seller. Third, risk coverage, which means forfeiting covers most risk like non-payment or political risk. in international trade, making it safer for the exporters. Fourth, documentation, which means proper paperwork such as export contracts and guarantees is essential for forfeiting to ensure smooth transactions. Fifth, transaction size, which means forfeiting is usually used for large high value international transactions obtained over 1 lakh rupees. Next, concentrate. 6 pointers concentrate. It focuses on medium to long term credit period, typically between 6 months to 7 years. Seventh point is who uses it? Exporter use forfeiting to get instant cash and reduce risk when selling goods to the buyers in other countries. Next point is export factory. First of all, we will understand the meaning of export factoring. The meaning of export factoring is a service that helps businesses get quick cash for their unpaid invoices from international customers. Instead of waiting for the foreign buyers to pay, the businesses sells these invoices to a factoring company. The factoring company gives the businesses most of the money upfront and collects the payment from the buyers later. It's a simple way for the exporters to improve cash flow and reduce the risk of not getting paid. Here are some points including export factoring. First, types of receivable, which means it handles unpaid invoices for goods or services sold to foreign customer. Second, recourse. Recourse factoring, if the buyer doesn't pay, the exporter must repay the factoring company. Non-recourse factoring, the factoring company takes the loss if the buyer doesn't pay. Third, risk coverage, which means it protects exporter from risk like buyers not paying or problem in the buyer's country like political or economic issue. Fourth, documentation. Exporters needs to provide invoices, shipping documents and contracts for the factoring process. Fifth, transaction size, which means export factoring is based for small to medium international sale. Sixth, concentrate, which means it focuses on short-term payments, usually within 3 to 6 months. Seventh, who use it, which means exporter who need quick cash or want to avoid payment risk use these services. 8. Cost layout. Exporters pay a fee based on the invoice value. If they get cash upfront, they may also pay interest. It's slightly more expensive, but provides faster cash and peace of mind.
Next point is net cost of factoring, in which we are going to learn detailed breakdown in which there are formula included in net cost of factoring and example calculation of net cost of factoring. First, detailed breakdown. First, advance payment formula, advance payment invoice value into advance rate percent. Second, interest on advance formula, interest cost is equal to advance amount into time period days divided by 365. Third, factoring fees. Formula: factoring fees is equal to invoice value into factoring fees rate percent. Fourth, cost of saving. Reduced collection cost, reduce bad debt risk. Now, next, example calculation. Let's say you sell an invoice worth 1 lakh to a factor under the following terms: advance rate 80%, interest rate 6% per annum, factoring fees 2% of invoice value, collection period 60 days, saving on bad debts, and administrative cost 500. Solution: Step 1. Calculate the advance amount. Advance payment formula is invoice value into advance rate. So, invoice worth rupees is 1 lakh. So, we have taken here 1 lakh into advance rate is 80% is equal to 1 lakh into 80%. The answer is 80,000. Step 2. Calculate the interest on the advance for 60 days. Interest cost is equal to advance amount into time period divided by 365. So, we have take here interest cost which we have got from step 1, which is 80,000 into interest rate is 6% into collection period is 60 days divided by 360 is equal to 80,000 we have taken as it is into 6%. So, 6 divided by 100 is equal to 0.06. We have calculates percentage of 6%, which is 0.06 into 60 divided by 365. The answer is 0.1644 is equal to 80,000 into 0.06 into 0.1644. The answer is 789.86. Step 3. Calculate factoring fees. Factoring fees is equal to invoice value into factoring fees rate. So, invoice value is 1 lakh into factoring fees is 2%. So, 1 lakh into 2% is equal to 2000. Step 4. Subtract the cost of saving. The net cost of factoring is equal to 789.86, which we have got from step 2, plus factoring fees which we have got from step 3, which is 2000, bracket minus 500 from the bad debts and administrative cost is equal to, firstly we will solve the bracket according to the BODMAS, which is 789.86 plus 2000, which is 2289.86 minus 500. So, 2289.86 minus 500 is equal to 1789.86. So, the net cost of factoring for the transaction is 1789.86. This calculation reflects the total cost of company after factoring in the fees, interest, and any potential saving from outsourcing the collection process. Conclusion: factoring and forfeiting are essential financial service for businesses. They improve cash flow, reduce risk, and support global trade.